Hello students, welcome to the lecture on investment in securities. In this lecture, we will explore the fascinating world of securities investing. We will learn about various types of securities such as stocks and bonds. Stocks means shares, and understand how these investment can play a crucial role in growing your wealth and achieving your financial goals. So securities, what is securities? Securities are financial instruments that represent ownership or debt in an entity. They are tradable and have monetary value. Investor purchase securities as a means of investing their money and expecting returns either through capital appreciation, interest or dividends. On stocks, you will get capital appreciation, and in case of bonds, you get dividend or interest. Here is a brief explanation of securities or type of securities. The first type of security is known as equity shares. Equity shares are also known as stocks, represents ownership in a company. When you buy a stock of a company, you become partial owner and have right to vote on certain company matters and receive share in company's profits in terms of dividends. If the company, of course, want to distribute it. The value of equity shares can fluctuate based on company's performance and market conditions. The second type of security is called as debenture or bond. Debentures are bonds or debt instrument issued by companies or governments to raise funds. When you buy a debenture or bond, you are essentially lending money to the issuer, means in government. In return, issuer promises to pay periodic interest and return the principal amount at the maturity date. Bonds typically have fixed interest rate like or bank fixed deposits, and their prices may fluctuate based on market interest. Interest rates. The third is called as mutual fund units. Mutual fund are investment vehicles that pull money from multiple investors to invest in diversified portfolio of stocks, bond, and other securities. When you invest in a mutual fund, you are issued mutual fund units proportional to your investment. The value of mutual fund units is linked to the performance of underlying investment in the fund. The next type of security is called as government securities. Government securities are also known as government bonds or treasury bills issued by the government to raise funds for various purposes like development purposes. These are considered relatively safe investment because they are backed by the government. Similar to the bonds, they periodic interest on the holders of government securities. Now, these are the securities. What are not securities? The following financial instruments are not considered securities. The first is fixed deposit. The bank fixed deposit is not a security. Insurance policy is not a security. Public provident fund. These are the various investment avenues, but they are not considered as security. So, to summarize, securities represent ownership or debt in an entity and are tradable financial instruments. Means you can sell them, you can buy them, they are tradable. They include equity shares, bonds, debentures, mutual fund units, and government securities like treasury bills. On the other hand, fixed deposit, insurance policies, provident funds are not considered as securities. What is security market? Security market is a financial market where various financial instruments known as securities are bought and sold. It serves as platform for investor to trade these securities, which can include shares, bonds, and mutual fund, whatever we have discussed just now. Participants in the security market are investors. These are the individuals or institutions uh, that buy securities with the aim of earning return on their investment. Issuers is also participant in the security market. Issuer are companies, governments or other entities that offer the securities to the public to raise capital. Stock exchange is the marketplace where the securities are bought and sold. Brokers are agent in the market. They are intermediaries who facilitate the buying and selling of securities on behalf of investors. All the securities we have just discussed are traded in security market. So one thing here you should note that investing in securities market involve risk. The retail investor should conduct thorough research and seek professional advice before making investment decisions. Now we will talk about investment in stocks. Investing in stock market carries both risk and advantages. As for first principle of investment, higher risk often leads to better returns. The stock market being one of the riskiest investment option, it offers potential for highest returns. Of course, by conducting thorough research, making wise investment decisions and being patient, you can unlock potential for significant return. So to understand the potential of security market, let's take an example of HDFC stock. This stock is or this bank is known to everybody. In 2007, the stock price was approximately 600 rupees. You can see on the graph. And presently, by the mid July, it is trading around 1700 rupees. This substantial increase over 3 years reflects threefold growth in your initial investment. By using a rule of 72 that we will discuss or we have discussed in the last lecture, the returns amount to be around 24%, four times than typical bank interest rate. So this example illustrates that careful selection of stock can yield surprising and liquidative returns, making stock market as attractive avenue for investors willing to take associated risk. The upcoming two slides will display the entities responsible for creating and eroding wealth in the stock market. As I told you, you have to be very cautious while investing in stock market. Stock market is the riskiest investment instrument, or other equity is the riskiest investment instrument. Of course, by the end of the lecture, you will come to know how to avoid the risk and how you can make the profit out of investment in stock market. So first slide will showcase the top gainers over the past 1 year. Notably, Titagar rail system share have delivered impressive 400% return within a short period of 1 year. For instance, if you had invested 100 rupees in these shares, your investment would now be valued at 400 rupees. If you have invested 1 lakh rupees in these shares, your investment would have now been at 4 lakh rupees. Moreover, several other shares have yielded return over 200% in just 1 year, means your investment would have been doubled in just 1 year. Now let's move to the next slide. In the next slide, these are the wealth destroyers. For instance, investing in NIIT shares could have resulted in significant loss with a decline of 70% in just 1 year. So engaging in stock market is a complex endeavor demanding extensive research, patience and dedicated time. Of course, constant vigilance is essential. You have to be very cautious. Daily you have to check price of your stock. Novice investor are cautioned against initiating their investment journey with stock market. You should not start your investment journey with the stock market. First, you should explore other options of investment. A safer option is to indirectly participate through mutual fund investment, which can offer uh, significant returns. For those interested in direct stock market investment, blue chip stocks are a preferable choice as they carry low risk of wealth depletion. We will discuss in this lecture what are called as or what are the blue chip stocks. So first, what is stock? So stock is a financial instrument that represents ownership in a corporation. When you buy a stock, you become shareholder and own a portion of company proportional to the number of shares you hold. As a shareholder, you have claim on company's assets and earning. If the company does well, the value of your shares may increase. allowing you to benefit from capital appreciation. Additionally, as a shareholder, you may also receive a portion of company's profit in the form of dividends. Now, what is stock market? Stock exchange or stock market is like a big marketplace where people can buy and sell stocks. It's like a fair where companies sell their uh, pieces to public and people can buy them. The stock exchange makes sure that everything is done fairly and follows some rule. It helps people trade their stocks easily and quickly. Some well-known stock exchange in India are Bombay Stock Exchange and National Stock Exchange. They play an important role in financial world by helping companies get money and allowing investors to invest in the businesses. So if you want to invest in like Infosys, you can buy Infosys shares. So you can become part owner of Infosys. There are 23 stock exchanges in India. Among them, two are national stock exchanges, namely Bombay Stock Exchange and National Stock Exchange. The rest 21 are regional stock exchanges. In Pune, we have a stock exchange. Approximately 70 to 80% of the total trading of all stock exchanges in India used to take place on National Stock Exchange called as NSE, while BSE accounted for around 20% to 30% of the total trading volume. So if 100% is the total trading volume, 70 to 80% take place in NSE, 20 to 30% takes place in BSE, and remaining 5 to 10% takes place in other stock exchanges. Bombay Stock Exchange, established in 1875, it's India's oldest stock exchange. It holds world's largest number of listed companies. BSE's benchmark index is called as Sensex, is widely tracked in India. This Sensex reflects market sentiment, whether the companies are performing well or not. It remains crucial platform for capital raising and investment in India in financial landscape. Another stock exchange in India is National Stock Exchange called as NSE. It's a prominent stock exchange located in Mumbai. It is established in 1992 with the primary objective of introducing transparency and efficiency in the Indian stock market. Over the years, NSE has grown to become one of the largest stock exchange not only in India, globally, ranked by market capitalization. So by market capitalization, NSE, National Stock Exchange, is one of the largest stock exchange across the world. Now let's see what is stock market index. You must have about Sensex and Nifty. These are called a stock market index. In simple term, a market index is like a measuring tool that show how well the companies listed on the stock market are doing or stock exchange are doing. It gives us an idea how the stock market is performing overall. The index reflects any ups and downs that happen in the stock market. So when the stock market goes up, index goes up, and when the stock market goes down, the index goes down. These indices help investor understand the pattern of stock market and make decisions about which stock to invest. It's like having a guide that tell you how the stock market is moving. In India, National Stock Exchange uses index called as Nifty, and Bombay Stock Exchange uses index called as Sensex. These indices help investors keep track of how the stock market is doing and make smart investment choices. Now, let's see Sensex and Nifty in detail. Sensex is the stock market index of Bombay Stock Exchange with a base value of 100. Sensex is a stock index which includes shares from top well-established 30 companies. based on their performance and financial soundness. So if these companies, these 30 companies are performing poorly, then the market trends are down, Sensex goes down. However, if only these 30 companies are outperforming, the market trends are bullish. So Sensex does not really reflect the overall market, it reflects the top 30 companies. The next is Nifty, called as, or Nifty 50, means National Stock Exchange 50. The Nifty name comes from combining national and 50. It is made up of 50 well performing stocks from various companies listed on NSE. The main purpose of Nifty is to track overall performance of Indian stock market. By collecting sample of 50 strong and actively traded stocks, Nifty can give us good idea how the stock market is doing. Unlike the Sensex, which has 30 stocks, Nifty covers the broader range of companies with 50 stocks from 20 different industrial sectors like IT, like manufacturing, pharma, then metals. So, which means Nifty provides a more diverse and comprehensive picture of stock market's health. Because Nifty includes a larger number of stocks and represent more sectors, it is often considered more significant and reliable indicator of overall market trends compared to Sensex.